Hey everybody, it's finally happening. That move we've been talking about for weeks now is finally here. WTI prices in the mid 50s, but now what? Let's talk about it this week in oil. Hey, I'm Aaron with 30 years of experience in oil trading and analytics, and I'm here to elevate your understanding of the oil market. All right, first let's start out by looking at where prices have been. As you've probably seen, we got a pretty big sell off these last couple of weeks. Here's a weekly chart of front month WTI of the continuation chart on WTI. So we're kind of down to where we were previously in terms of the body shapes. Back here in the May timeframe, you can see this big rally that took place in June. That was the Israel-Iran confrontation that went on for 12 days. And now that's kind of calmed down. We've been through the bulk of the summertime, good demand season. And now we're back into this shoulder season, which we've been talking about for weeks now, where refining demand cools off and the crude market starts to feel heavy. And it's just what it does every year. Now, there's some interesting things going on in tandem with this, especially some of the big reporting agencies and forecasters have this sort of narrative or mantra out there that the market's way oversupplied, especially with OPEC bringing barrels back on the market and that sort of thing. And there's an interesting Bloomberg story I wanted to read for you uh, here. So allow me to do that real quick, and it'll hopefully show sort of what I'm talking about here. So earlier this month, just a couple days ago, actually, the International Energy Agency, which is kind of the go-to, it's kind of the numbers you start with as an analyst, or at least you try to square yourself up against what the IEA is saying in terms of projections for supply and demand. They look globally. They look at a lot of the big trading regions, OECD, non-OECD, some of the bigger countries, China, India, US, EU, as a whole, that sort of thing. And they do go down into some of the detail of some of the bigger European countries as well. But it's usually a number that, or a sets of numbers that come out every month that's pretty well referenced by analysts in the market. And of course, you're free to disagree with them, as I usually do. But at least it's a good reference point, and it's sort of that one point that everyone in the market sort of knows about that number. Maybe it's something you have in common. You could talk to other analysts and say, wow, did you see the IEA is talking about this, this, and this? And they're probably going to respond with, yes, they saw that, and then with their opinion on it. So anyway, let me read from this story from Bloomberg earlier this week. I believe it came out on Thursday the 16th. But it's saying International Energy Agency projects a global surplus of 2.35 million barrels per day in 2025 and 4 million barrels per day in 2026. So that's sort of already been known. That's sort of been out there, at least the oversupply narrative. The problem comes, and what I wanted to talk about is for the month of August when they're trying to do their reconciliations. The way the story that I'm reading from goes that there's 1.5 million barrels per day of crude that went missing in August, versus their balances. So that's another thing as an analyst you sort of struggle with. You've got your supply variables, you've got your demand variables, and then you've got the change in inventory. And as we've discussed before, the most recent inventory numbers are always somewhat in flux. You're never exactly sure how accurate those are as time goes on, and you have time or as the market has time to go back and sort of refine those numbers a little bit and solidify them. They will change, and I'll show you that here in a minute, at least from OPEC's perspective, how they handle that. So yes, you can flag big problems like this, but again, maybe the numbers you're dealing with are not as solid as you would like. But at any rate, what the story goes on to say, they were unable to account, the IEA was unable to account for 1.47 million barrels per day of oil in its global balances for August. So that's 45.5 million barrels over 31 days. To put that in reference, they say July was 850 and 370,000 barrels per day in the second quarter overall. I'd say that 370,000 barrels per day is probably pretty typical. one way or another that barrels go missing just because things are moving, especially on a global balance. You've got things moving all over the place and, all sorts of things going on. But the 1.47 is a big deal. That's a lot of barrels missing. That's 45 million barrels that they can't find a home for. So that's causing some of the uh, maybe bloom to come off the rose a little bit in terms of this oversupply narrative that's going on. As you probably know, from earlier videos that you might have seen from me, I'm not a huge believer in the oversupply uh, narrative. I think demand is doing better than what we're seeing. I think China is soaking up quite a bit of barrels, not only for financial reasons, just because it's relatively cheap and they've got plenty of space to do it, but then, as certain viewers have pointed out in the comments too, there's probably practical reasons to be doing that, just given all the stuff going on the geopolitical stage. Uh, um, some of their best suppliers, especially with regards to Russia, are those barrels going to be available in the future? Are there going to be big sanctions that actually bite enough that China has to back away from buying some of these Russian barrels? So from a Chinese perspective, I think it makes a lot of sense to be hoarding barrels or to be storing a lot of barrels at this point in time. Just from maybe a strategic perspective and not just a business or financial perspective. So at any rate, the story goes on to say that KROS, which is another agency that, again, I would stand behind if you're in the market. I would suggest you take a good close look at them and perhaps get a subscription. I'm not, they're not funding me or anything. It's just I've used them in the past and I found them to be very useful. Anyway, the IEA is saying that the data from KROS is seeing a crude increase of 110 million barrels in China between April and August 2025. Sounds like a lot. It's not really a lot. That's we've seen that sort of thing before. They've got plenty of storage still. Again, according to the KROS numbers, not only will they give you where they think inventories is, but they'll give you what total capacity is. And we're running somewhere around 60 to 70% capacity. Plus, they're building more. There's a report a couple weeks ago that China was building another 90 million barrels of crude storage in the next 2 quarters. So by the end of Q1, those should be in place. So if you even set aside the spare storage capacity that China has right now, they're going to basically build again what they've just filled up in this April through September timeframe. Sorry, April through August timeframe. They're going to build that capacity fresh again and potentially be able to fill that up as well. And I think, as I discussed a couple weeks ago, it's very rare for crude oil to come back out of China. Once they import it, they hold on to it. The big warning sign, the big bear sign for me would be if China was to stop buying crude, especially at these lower prices. If we get up to, for whatever reason, if there's some geopolitical event that takes us back to $100, I would absolutely expect China to stop buying at that point because it's so expensive, or to at least slow down buying. But at this mid $50 price range, I would expect them to keep hoovering up as many barrels as they could, because, again, from a long-term perspective, it's probably some good insurance and just strategically probably a good idea for them to be doing. So I wanted to mention that to you right away, that the other market participants, not just me, are noting that there are some flaws in this oversupply narrative that's going around out there. Again, the IEA is a good agency. I'm not sure, so I can't say anything bad against them, but this forecast doesn't seem to be working out. So just for what that's worth. But let's continue on here, and I'll show you what I'm talking about. In terms of the OECD numbers, so these numbers are from OPEC, from their MOMR report, which is a little bit redundant, but you can see on the left-hand part of the screen over here that they've, this is the most recent sets of data for this year so far. We're not quite at 5-year lows. We're just a little bit above, but there's a lot of many different years here that have sort of similar inventory levels at the point we're in right now. So I think it would be hard from this perspective to say that OECD stocks are high. They're certainly not. And then this chart on the right, again, is sort of the evolution of the changes that I spoke about. So the most recent data point is probably going to move around a bit. And the way the way OPEC does it anyway is they'll move that around for 3 months. So the bigger the change you see in each color here, the more that data point has moved around. The one we were really concerned about was June. It started up here at 1.348 billion barrels. Then they revised that all the way down to 1.313 million barrels. And that's a big revision, and that's um, that was the revision that came out when OPEC went ahead and made one of those big increases for the 500,000 barrel per day increases. So you can see taking that many barrels out of the balance, which is basically what has happened to the IEA, if you think about it. So 45 million barrel drop is what the IEA is having trouble with, or they don't see where those crude barrels have showed up in the month of August, if that makes sense. So that's a similar scale to what we're saying here, just for the OECD markets that OPEC had to deal with. And then the latest indication, they did bounce back up for the month of June. And so now the final number for June, as far as OPEC's concerned, is going to be that 1.327 billion barrels for OECD inventory. So that just kind of goes to show you how things do bounce around. You don't want to be too quick to judge what's going on, especially with these inventory numbers here in the front. You want to be a little bit skeptical of the data itself. But the way this is panning out is it's sort of coming to a more reasonable number in terms of we've seen this sort of inventory before for the month of August. So again, that sort of seems to make sense from that point of view. So again, OECD is going to be the West. It includes Korea and Japan in Asia. It's going to be most of Europe. It's going to be Canada, U.S., Mexico, that sort of thing. So it does not include India, does not include China. So those are some really big countries in terms of not only population, but oil flows that kind of skew these numbers a little bit. But for the West is how I think of it, the West plus Korea and Japan, inventories are quite tight in the OECD, at least on the crude side of things. Another thing I want to talk about this week is we had a big drop in runs over the past few weeks here in the U.S. Typically in the fall, there's obviously a maintenance season that happens twice a year in the spring and in the fall. What typically happens is in the spring, you get a much more spread out turnaround season, maintenance season, where it may not be as deep and as fast, but it's more spread out. It's interesting. I did some research last year, and if you get if you go ahead and sign up to our Elevate Your Understanding report, I go through this quite a bit in this week's report. So please visit our website and look for this and get it on a trial version for it. But one thing I go into quite a bit in this week's report is, again, looking at sort of what happened in terms of refining demand over the past year. If we go back to, sort of late fall, early fall of 2024, we hit sort of a maximum of 16.9 million barrels per day late in September. And then we went into a quick turnaround season, bounced back up somewhat into November. So it was a relatively short time period between, sort of September and November. We're right back at that 16.9 million barrel per day number. And then things just drop off a cliff as we go into 2025. And it took us from that November print of 16.9 million barrels per day in November of 2024. It took us 26 weeks to get back to a 16.9 print or higher in the US. So that would have been in May. So literally took half a year for things to bounce back. So there's, obviously a couple of things going on. There was more than just planned maintenance that happened. that year, but it was pretty interesting that we had such a big drop down in refining demand in the first half of this year, and it's obviously really taken off. We hit 7.2 million barrels per day in August, which in my mind is pretty darn close to max capacity in terms of things that should normally be turned on in that sort of thing. So we're coming down off of that, of the 17.2 number about 8 weeks ago, and this week we hit 15.1. 15.13, I believe. So just a huge drop in refining runs. Again, that should bounce back fairly quickly. We'll see what happens, but obviously pad 2. So let me back up a little bit. Pad 3, I can account for most of this drop. In other words, we have turnaround schedules. We kind of know what's going on in terms of planned maintenance going into the turnaround season. Pad 3 roughly makes sense to me. It's off, or it's bigger by maybe 200,000 barrels per day, which again, given that we're talking about a 9 to 10 million barrel per day complex in the Gulf Coast, that's not such a big deal. That sort of thing happens. If we go here to pad 2, though, where you're looking at like 4.5 max, something like that, something around there, to drop down. So we've got about 700,000 barrels per day offline versus recent maximums. And that's a lot bigger than what I can reconcile about what, issues that I knew were going to take place in terms of that fall turnaround season. So that's quite big. The other interesting thing is if you take a close look at inventories, Cushing, as we'll see here in a minute, I have the chart in the pack this week. Cushing stocks are not really increasing, but Cushing stocks outside of Cushing, so pad 2, but not Cushing stocks, are increasing, which gives us a little bit of clue that whatever this big outage is not a refiner that draws directly from Cushing, what I call the Cushing envelope refiners, which are pretty much in Oklahoma and in Kansas. You have the CHS refinery there that can pull directly from Cushing. But so maybe this is BP Whiting having issues. We certainly saw some headlines that they were having some issues. They do have some planned maintenance going on. It's only about 90,000 barrels per day in terms of a crude unit that we know about for sure. Perhaps it's bigger. It's a 440,000 barrel per day refinery, so that would certainly fit the bill if the whole thing was offline, and maybe make that sort of more reasonable. And then the other big swing was here in pad 5, where all of a sudden now we're at the bottom of the 5-year range in terms of crude throughput. Pad 1 seems to be holding strong, though, at very high levels. As you remember, we had a really big turnaround in the spring of this year, and so hopefully that means they can sort of skate through the fall turnaround season with only minimal interference going on. And I should say margins are still really good, especially in the Gulf Coast, so there's no financial reason for these guys to be slowing down. Margins are strong enough that you'd want to keep running as a refiner. But at any rate, let's switch over to production. So in the weekly data, we did make a new high. These past 2 weeks, it's 13.636. The previous 5-year high was 16.631. So just barely a new high, but it's a new high. The last high was in November. It's this little peak right here. So within the weekly data set, we're kind of screaming along. We set a new record. What's interesting is the monthly data that comes out, which is again more reliable because the EIA has had more time, the DOE's had more time to go back and look at those numbers and make sure that they're correct. Whereas again, we should be a little bit skeptical of these weekly numbers. The monthly numbers have a bit more respect for them. But we're already higher than that level on the monthly production numbers. So again, just directionally, the latest data set is from July, and looks like at least on the weeklies we've increased quite a bit since July. So I think that would be interesting here in the next couple months as those monthly data points come out. But the point I wanted to talk about for right now is crude production is definitely on an upswing. If you look at where price has been so far this year versus previous years, obviously we've been on a bit of a different trajectory, with all the uncertainty, things sort of trending down, especially after the Trump tariffs and that sort of thing, and again, these are monthly average prices. So getting below $65 here early in the or late spring, early summer, and then June and July bouncing up above 65. But I think what's interesting here is if you look at the change in production growth so far this year, so this is monthly production changes versus end of previous year, things are chugging along pretty good actually. If you just look at the April through August timeframe or April through July timeframe, we're up about 100,000 barrels per day, which is pretty much what we had done in 2022. So if you can see this orange, the darker orange line here, we're pretty much sitting right on top of it. What I think is super interesting about that is here's the price from 2022. So obviously the market was ripping in 2022, right? And we're at a similar production level with much lower prices. So again, that speaks to some of the efficiency gains going on and that sort of thing, that we're able to continue at a somewhat stable rate of production, even with much lower prices. So again, if you look at last week's video about my experience at the Weatherford conference, you can see where some of that stuff is maybe starting to already find its way into the market. It seems like, again, with regards to the Weatherford things that I saw from last week's report specifically, it seemed like those haven't really been deployed in a wide range in the US. But that technology is certainly available and would again help us to continue to grow production in the country. Inventories are still pretty low, though, overall. As I sort of hinted at, these four charts represent the big four, if you can call them that, the big four NYMEX futures markets. WTI is deliverable at Cushing, Oklahoma, where we're pretty much at the bottom of the 5-year range. The gasoline contract, the RBOB contract, is deliverable in New York Harbor, where again, stocks are low near the bottom of the 5-year range here. And then distillates, this would be your heating oil or your diesel fuel. This is pretty much the same thing, just the sulfur content's different. Pad 1B, again, New York Harbor, diesel is not quite at the bottom of the 5-year range, but it's pretty tight, right? So any weather that comes in to New England in terms of early snow or early cold, this is not a good situation, or this is a bullish situation, depending on how you're sort of looking at it right now. So, inventories are still quite low. Here's the national view. So not just zooming in really closely at the NYMEX delivery hubs, but more generally at the national averages. Jet fuel is for right now just above the 5-year range, so that seems a little bit loose. Propane is doing what it should be doing this time of year, building, but we're obviously about to go into heating season, so that's going to start drawing back down again. So we're probably near the top in terms of inventories on the propane market. Gasoline nationwide is a little bit better than what we're seeing in Pad 1B in New York Harbor, and diesel stocks are a little bit better than what we're seeing in New York Harbor, but not by much. So again, from an OECD perspective, crude inventories seem tight around the world, especially with the data we have looking back at August. On the weekly data set, U.S. inventories, which again is a huge part of that OECD number, still seems pretty tight, with maybe the exception of jet fuel over here. But otherwise, things appear fairly tight. So again, margins, refining margins are good. So once we've got more than expected refineries offline, which is probably going to keep margins chugging along. Again, we've got decent demand numbers that we've been looking at here the past couple of weeks. So from that perspective, from a refining perspective, I think things actually look pretty decent, especially when you consider how much cheaper crude is, which from a cash flow perspective is a good thing if you can keep margins the same. If you can keep making $20 per barrel on, earlier this year, if you're making $20 per barrel on $70 crude, that's good. If you can make $20 per barrel on $55 crude, that's even better, right? Because your capital expense of paying for that crude in the first place is lower. So that relative margin is actually bigger in terms of percentages, if that makes sense. The other thing I wanted to touch on real quick, just kind of going through these recaps, is with flat price being this low, we kind of talked about, okay, so what's next? We had been targeting $55 crude price for a while now to go back and retest that. Does the market blow right on through that number? Perhaps we'll see what happens here. From my perspective, there's like zero uh, geopolitical price risk or risk premium priced into the market, which is a little bit crazy with all the things that's possibly going on. There are some talking heads out there that I listen to that are talking about Israel Iran flaring up again. So that would be again a huge deal if something were to happen to the Persian Gulf. It's not our first case scenario that Iran would immediately close the Persian Gulf or anything like that, but accidents could happen. Um, and if let's back up and just say if something were to happen to close the Persian Gulf, that would be catastrophic to the global oil markets. So just keep that in mind for what it's worth. There's plenty of other geopolitical situations going on all over the world. You probably know what they are already, but it's kind of crazy to me that the oil market's not pricing in any risk premium for all these different things going on in the world right now. So does the market stop at $55 and bounce? That's probably going to be a bit of a tough question. If it does, I think that would be considered like a triple bottom and probably rally pretty hard from there. If not, again, I think we get a few more weeks of builds, especially with runs so low in the U.S. It's likely that we get some more builds. Are they going to be impactful? I don't think so. We'll see how that works out. Another thing we talk about in this week's Elevate report, like I mentioned, go to our website and get on that Elevate report. We talk about the contango in the market that we're seeing in Cal 26 now and the significance or not of that. We have a good discussion on that, I think, this week. So go ahead and look at that. But one thing I wanted to point out really quick, if you paid, if you've gone all the way through this, if you one thing I would really want to point out to you is if you are an end user especially of diesel fuel, so maybe you're a construction company, maybe a trucking firm, anything like that, the Gulf Coast wholesale market, so there's no taxes, there's no transportation, anything like that is pricing right around $2 per gallon for all of Cal 26 right now. So if you're a big end user like that, I would definitely try to look into locking in those sorts of prices for next year, especially if that works in your budget. You can do different fixed forward type things, which would help you lock in those prices for the balance of the year. If you need help doing that, definitely contact me and we can talk through it and maybe get you some direct help in doing that. But again, I think we're getting down here towards prices where the end users should really be looking at these forward prices and talking about locking those in, if that makes sense for your company. So that just wanted to give you that tidbit there. And again, if you want to contact me, I'm definitely here to help you for that sort of thing, and we can sit down and talk about it. But anyway, thank you. That's the report for this week, and hope you have a good week. Bye.